Welcome to CNY Markets Coffee Break. I'm Tony Nash. In each of these CNY Markets Coffee Break episodes, we're looking at two items from CNY Markets, which is our AI forecasting platform. Within CNY Markets, we have 1,800 items that we forecast every weekend. So every Monday morning for $25 a month, you get brand new forecasts for individual equities, equity indices, ETFs, commodities, currencies, economics, and more. So please take a look at CNY Markets, completeintel.com/markets. This week, we're looking at the Chinese yuan CNY, and we're looking at crude oil, WTI crude. So let's look at USD CNY. Just a little bit of historical context. In 2022 and 2023, we saw a sharp rise of CNY post-COVID, peaking at, say, 7.3. A lot of this really had to do with dollar strength, fueled by some Federal Reserve activity and really economic slowdown in China as their economy slowed and their currency weakened. They needed to goose exports post-COVID. In 2024, we saw some stabilization of CNY. It stabilized between, say, 7 and 7.2 through most of 2024. We really saw weakening in the end of 2024, November, December, as we saw more hawkish language come from the Fed. For Q1 2025, we expect the average for USD CNY to be between, say, 7.15 and 7.2 for January, February, and March. The exchange rate will remain pretty stable despite depreciation pressures. With Trump coming into office, the biggest factors here really are the Trump and Xi Jinping relationship. Of course, that's backed up by the Chinese Finance Ministry and the PBOC, as well as the US Treasury and the Fed. But the relationship and the positioning of those two will really have a big sentimental impact on that USD CNY pair. The Fed is expected to hold rates through Q1. We're not expecting dramatic Fed change of policy, but we really are looking at kind of risk on sentiment. Do people really want to move back into China? Do we see equity flows back into China? And what's happening with China's trade surplus? Another key consideration is the outflow from China's bond and equity markets. We did see at the end of 24 a big outflow, and that really contributed to the devaluation of the CNY. As we've said many times before, we do expect China to push back verbally on what the Trump administration says, but we do expect them to align with US policy after, say, 3 to 6 months. Let's move on to oil with WTI crude oil. Again, a bit of historical context. We saw a rally in 21 and 22. This was really post-pandemic uplift based on economic activity and other things. We saw crude surge to $120 a barrel in 2022. We also saw supply constraints in 2022 because of the Russia-Ukraine conflict, and we saw OPEC plus price or production cuts, limiting that supply. 2023 really saw stabilization. Prices fell back below $80 in mid-2023. Recession fears in the US really started to slow down, but we saw prices stabilized by releases from the Strategic Petroleum Reserve. 2024, we really saw oil prices range bound in the mid-80s, at least WTI prices. So for Q1 25, we expect crude to trade between, say, $70 and $75 a barrel in January, February, and March. Month to date, so far in January, although it seemed that prices have risen quite a lot, it's been around $75. Our forecast is for 71, 72 in Jan. And again, we expect it to be pretty range bound for the next couple months. Some supply side factors to look at is OPEC plus policy. Will OPEC plus keep the production caps? Will they loosen those caps? Not really expected to change, but a move one way or the other could move price. Settlement of the Russia-Ukraine war and allowance of, say, Russian oil exports would, say open Russian oil exports. They're exporting anyway, but more accepted Russian oil exports would really help that price kind of to the downside. Demand side factors. Trump, actually, this is a supply side factor. Trump saying drill, baby, drill. Of course, he was inaugurated on Monday, but will we actually see more supply come online? We're skeptical we'll see that in the first, say, 3 to 6 months. but maybe 6 to 9 to 12 months, we can see something. There are a lot of industry dynamics and say physical aspects that are required there, not to mention the regulatory aspects. But it's more complex than political statements make it sound. Of course, we also have to pay attention to China's demand. Will China's economy recover? Will the US remain strong? And how will that affect oil price? We're also looking at rates. So if the Fed and the ECB stay steady, as we've expected, again, we'll probably see this oil price range bound. We don't expect a lot of movement in those two because they want to limit risk as Trump comes into office. There are so many things moving in the macroeconomic environment and geopolitical environment that we expect those guys to stay steady to reduce the, say, uncertainty risk from central bank policy. So thanks for joining us for this CNY Markets coffee break. Please check out CNY Markets for free at completeintel.com/markets.